Surging energy prices are the latest supply headache and possibly the most serious one yet for the global economy. My next guest says the world is on a collision course with commodities, and energy and tech names will be a good hedge. Joining me now, Charlie Babrinskoy of Ariel Investments. He's the vice chair. And Jerry Castellini of CastleArk. He's the chief investment officer. It's great to have you guys both here. And Jerry, I'll start with you. I've been borrowing and cribbing from your notes here. Tell me to what extent you think this commodities collision course can last.
So I think it's more a question of it's something that people have acknowledged and been able to observe now actually coming to the forefront, right? We've been talking about supply chain for the last 6 to 9 months. And a lot of the focus on it has underlined or masked what is also behind the supply chain problem. What we're going to probably see in the next 6 months is now real production shortfalls, right? So today, Brazil is out with a horrible forecast for their crop production. We know we're behind in oil and gas production because our inventories globally are behind. We just don't have the amount of raw commodity capacity today to touch the amount of growth that's most likely going to be in demand over the next 6 to 9 months. And so we're going to have to use price to adjust to that.
Right.
And what most investors haven't figured out yet is what do you do after that and how long does that last? And then that's a bigger discussion about inflation.
And that's exactly where I want to go with this. I wish we had more time. So you say that people should hedge at least the near term of what you're talking about, this spike that could continue its upward trajectory with energy stocks like Conoco, Diamondback, and Range. You also like tech, thinking that rates aren't that big of a threat to their business models ultimately. Let me bring in Charlie. Charlie, first for some thoughts. Not that you're, an energy and commodity specialist per se, but, once again, you're on in a week when the trade is coming around to where you stand. We have rates going up, financials and energy starting to outperform. How long do you think this situation can last?
A lot longer. I mean, Dom gave a great introduction, but the one thing he said was that the 10-year Treasury is at elevated levels at 150. On a historical basis, absolutely not. The average 10-year Treasury rate since Alexander Hamilton created 10-year Treasuries in 1790 is 4%. And with the inflationary outlook that I agree with Jerry that we're going to have because of every input cost, energy costs, labor costs, big deficits, all of those factors are going to push inflation higher, which is going to push interest rates higher. End of tapering, we are going to have a lot higher than a 10-year Treasury at 150.